Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Well, good afternoon and welcome to the COB. I'm Sue Lannon. Let's have a look at how the market finished up. So it was a lacklustre day and it got worse as the day went along. Investors disappointed by a number of earning reports. Now, there were also falls on Wall Street, so we saw tech stocks really take a bit of a hit. So the CBO 200 down 0.7% and the ASX 200s lost about 0.8% of its value. Tech stocks leading the falls. Let's have a look at some of the themes. It's been a weak week. A very weak start to November for global shares, especially in the US. That's as investors worry about the labour market and overvaluations of stocks such as big tech. ASX is on track for the second weekly drop in a row. Hit or miss. So we saw disappointed investors sell off a number of stocks, including Macquarie, after its half-year profit missed analyst estimates. And in fact, it lost more than $6 billion in market value today. We also saw Block sold off. It also missed revenue estimates, and Qantas fell after flagging slower domestic revenue growth. REA Group also missing estimates despite a 5% rise in EBITDA. And start spreading the news. Now, Nine Entertainment says it will cut $100 million in costs. That's as TV advertising slumps. And Nine says the ad market for the second half of 2025 was weaker than expected. It's also called for compensation. That's if the government bans gambling ads. And News Corp plans to announce further partnerships with technology companies. It says quarterly revenue lifted 2% to $2.14 billion US. So let's have a look at the sectors of the day. As I mentioned, tech stocks did fall. They tracked Wall Street lower as investors worried about overvaluations. We saw Wisetech fall to the lowest level in nearly 2 years. Also hit was Xero, Next DC technology company, and a big sell-off for Zip. Now let's have a look at the media stocks now. Nine Entertainment dropped, but News Corp rose. That says the revenue came in better than expected. And turning now to the banks. ANZ lost ground. As I mentioned, Macquarie Group closed down 5%, was down more than 7% at one point. Commonwealth Bank and Westpac also lower, but National Australia Bank rose. Let's go to corporate stories now. Now, as I mentioned, Macquarie Group saw an increase in net profit for the first half of the financial year. Block raised its full year 2025 guidance, but third quarter profit fell short of expectations. And REA Group says listings declined over the quarter, but says its performance is better than last year. And News Corp says increased profitability was helped by AI-related revenue, and now it expects to announce new media partnerships in the future. And Nine Entertainment painted a contrasting picture with upbeat digital subscription revenue and bleaker revenues from the advertising market. And oOh!media warned of a weaker finish to the year because of softer advertising conditions. And Qantas flagged that its domestic unit revenue is now expected to grow about 3%. That's at the lower end of guidance. And the Qantas-backed Alliance Aviation Services came out of trading halt. It flagged materially lower 2026 earnings due to higher aircraft and engine costs. Now, let's have a wrap-up of the day's news, and welcome to the COB, AMP economist Mi Bui. Thank you so much for joining us. Now, it's been a very weak start to November for global shares and the Australian market.
Yeah, totally. And I was actually a bit surprised with this as well, because supposedly November should be a good shares for month, both in the US and Australia. Nobody really knows exactly why this seasonality happens. The theory is that as we go towards the end of the year, traders should feel a little bit more positive and they should try to deliver positive results ahead of Christmas. And in Australia, we're coming into the summer month as well, so things should get better. But over the last week, we didn't really see that happening, especially in the US. So US shares have actually already fallen 1.7% over the week, and more than 2% from the peak from earlier in October. So this was definitely driven by two factors. One is that we've had weaker growth story in terms of alternative data for the US labor market. over the last week, we saw payrolls declining. Obviously, this is not the official payrolls number. This is just an estimate based on private surveys when the US government is still shut down. But that does shows the fact that the US labor market doesn't really have a lot of hiring at the moment. Job creation is probably slowing closer to zero over the last few months. And on the other hand, firing is actually increasing. A lot of people probably have seen these headlines of the Challenger job firing index. They show that job firing announcements actually reached the highest October number in 22 years. So that's pretty concerning for the labor market in the US. And I think because of this, consumer discretionary stocks fell a lot this week within the S&P 500. And the other factor that drove the fall in shares this week is definitely valuation concerns, as you have just mentioned now. I mean, this has been a concern for quite some time now. If you look at things like earnings premium, so you take earnings shares, so what you're getting out of stocks, compare that with bond yields, which is basically what you're getting compensated for holding a safer investment like bonds. You're getting really nothing extra. The equity risk premium is close to zero. So a lot of people have been voicing that elevated valuation and narrow risk premium concerns over the last week, which probably drove a little bit of a pullback in shares. I'm not sure if this story will...
Sorry to break in there. And the US earnings season is wrapping up. 80% of S&P 500 companies already reported.
Yeah, I mean, I think this is the other story on behalf of that equity risk premium story. The thing is, US companies are still generating earnings. In fact, tech stocks, which is the core of this whole AI bubble concern, they're actually generating the most amount of earnings, with earnings growth within tech stocks growing 27% compared to the previous years. So they are actually generating actual, earnings to support their rise in stock prices rather than just rising out of AI hype. So I'm not sure if this, valuation story will continue in the near future. What it just tells us is that, yes, there is a very high risk of correction, but I don't think it's a sign that we have a bubble. Over the medium terms, we're still pretty positive on shares.
Well, let's turn to a broader issue, and President Trump's tariffs are being challenged in the Supreme Court.
Yeah, totally. I mean, it is a bit quite entertaining to watch all these news. So what happens this year was that President Trump has definitely issued tariff announcements whenever he liked it and with whatever number he felt like the day. For example, the 145% threatened tariffs on China. The Supreme Court is basically debating whether he has the authority to actually implement these tariffs. Back in Trump 1.0, he did raise tariffs against China or against steel and aluminum industry, but he actually went through other avenues that were granted to him, either through Congress approval or through some federal investigations that actually takes time, or there's some sort of, laws that allows him to implement tariffs, but with some sort of limits or some sort of deadlines that actually expires. But this time around, he didn't use that. He used this thing called International Emergency Economics Powers Act, and the Supreme Court is debating whether he can actually do that. I mean, nobody really knows what's going to come out of this. Maybe he would lose, which basically means that tariff rates would go back down to below 10% compared to the 21% that economists estimate at the moment. But I think the big picture here doesn't really change. Tariff rates are still much higher than last year. If he can't not use this act, he can use other avenues to increase tariff rates. It's just a little bit slower, and tariffs are still going to be reflected in inflation going forward.
Well, let's come back home, and we saw the Reserve Bank stay on hold this week, and you say it mentioned uncertain 45 times in its statement. So where do you see the RBA going?
I think in the near term, we probably all agree that the RBA would remain on hold, especially in the December meeting, given that we don't really have a lot of major economic data coming out besides, a very lax GDP number and some more employment numbers. And the most important thing for the RBA at the moment, in their own words, is definitely inflation. The RBA is very concerned about the fact that we've had a rebound in trim mean inflation, especially with new dwelling costs, rental prices and some market services. They're very concerned about that. They think that we're going to see a 3 in front in terms of the annual inflation numbers in the next 2 quarters. So it is very hard to see them cutting anytime soon unless things deteriorate. I guess at AMP, we do have a little bit of a different thinking versus the RBA. We think that the labor market is rather weak rather than the RBA categorizes it as a little bit tight. And I think the evidence is that if you look at market sectors in the labor market, things like financial services, like a lot of our audience was watching, I think conditions are not great. For example, financial services wages grow at 2.6%. It's actually weakest among all industries in Australia. All the strong conditions in the labor market are actually either health, education, or public administration sectors, either that or housing. So there's just some quirky, either, a lot of government hiring in there, or some, little tightness in terms of the housing market rather than some sort of market cyclical sectors. So I think going forward, we do see the unemployment rate reaching to a peak of 4.6 to 4.7%, rather than going back to 4.4% as the RBA projects. And if this happens, the RBA probably has room to cut either once or twice in 2026. But definitely don't expect the RBA to cut even more than that. We're still going to have much higher rates than, say, 3 years ago.
Oh, thanks, Mi. And just finally, you've been having fun with Shane Oliver on Instagram recently.
Yeah, I mean, at AMP, we actually love doing these short TikToks and Instagram videos. You can follow us on the account called EconoSites. Sometimes we do just have some fun, like show a little bit of behind the scene of how, economists do our jobs. Like last week when inflation was a bit hotter than expected, we actually had to admit that, we got it wrong. But other than that, we also do very short educational videos about everything that we've been talking about today, but in just a more fun way. So do follow us.
Okay, Mi Boy from AMP, thank you so much for joining us and have a great weekend.
Thank you, you too.
And the stock of the day was Alliance Aviation Services. Let's hear from our experts now, Luke Winchester from Merewether Capital and Richard Hemming from Under the Radar.
They do have a great business in that they've spent all this money on improving their fleet, and they'll be able to get higher returns from those assets as we've seen with Qantas. But I guess it's just been set back that kind of return through these high maintenance costs. So we're still like, I own it. It's just given back a few months of gains. But I think overall the business is still a good one. It's just got to absorb this hit.
So given where it's fallen to today, is that a buy for you then?
No, I'm saying we're just holders at the moment, and we're just going to wait. I think
there's blue sky ahead. That's what you're going to say?
No, look, the only way is up.
There's a few moving parts of this. Managing director, CEOs resigned as well. Yeah, again, a lot of things going into this pod. I wouldn't rush to catch the falling knife. I don't think it's as bad as what a 40% share price fall would suggest. But I'm also not inclined to sort of, play around too much with these things where you have a balance sheet with nearly $500 million net debt. So I'll say watch sidelines. Interesting one, but wouldn't be rushing to pick it up today.
So let's have a look now at the big movers on the market. Firstly, let's look at the leaders. So AUB soared today, up nearly 7%. ASX, the market operator, also rose. News Corp rose nearly 4%. That's after investors were happy with its quarterly report. And looking at the laggards on the market now Block fell 15%. That's because investors weren't happy with its latest quarterly report. Qantas also fell as it sort of downgraded its growth forecast. Zip also took a tumble, as did the data centre operator Megaport. Let's turn now to the small caps. Jumping today was Freelancer, up 13%. Sun Silver rose more than 10%. And Azara Resources rose nearly 9%. And looking at the losers, now we heard then about Alliance Aviation. It lost 42% of its value. European Lithium fell more than 15%, and Lynas Diagnostics lost more than 12%. Now let's have a look at what's on overnight. The US University of Michigan Consumer Sentiment Index will be out. And looking at the week ahead, on Tuesday we've got the NAB Business Confidence Index plus Westpac Consumer Sentiment. Thursday, the latest unemployment figures for October. On Friday, the US Consumer Price Index and US unemployment data and earnings from ANZ, Life 360, Aristocrat Leisure and Xero. And let's have a quick look at how the market finished up. The CIBO 200 fell 0.7% and the ASX 200 also down 0.7%. As I mentioned, technology stocks led the falls, but banks and industrials and miners also weighed on the market. Thank you for watching. Have a good weekend.